So yeah, so we'll kind of focus on acquisition, specifically dealing with M&A transactions and LBO deals. So yeah, so driving value creation. So value creation is kind of driven by this clever balance of growth, return on capital, cost of capital, and the ability to sustain performance over time. And specifically, as we mentioned, you have the organic revenue growth. You have to have a core focus in the healthy return on capital, the sustainability of that performance, and to see if it can last over time, and your ability to manage risk, something that we kind of went over in last week's session. Yeah, this by Professor David Wessels. And a kind of strategic view of M&A is your portfolio choice. And empirical research shows that companies drive growth through three primary sources. And 8.6% of the growth rate breakdown is, that's kind of the national average, which is kind of done by McKinsey. One is portfolio momentum, which accounts for most of it, actually 5%. So you have some markets that are growing and have natural momentum to them, and they are kind of pivoting towards growth. And the other, you have market share, which accounts for 0.5%, which is kind of the hardest to capture, especially in the North American market, where kind of profits reign supreme, even above market share. And finally, you have mergers and acquisitions, which is 3%. And this is kind of tricky because if a $100 million company doesn't grow and acquires another $100 million company that doesn't grow, then you basically have $200 million worth of company that can't grow for you. So that's kind of the realities of M&A. So there is kind of a lot of upside to it, while also you have to bear in the realities of kind of sustainable growth. And how to use acquisitions to pivot. So companies use acquisitions such as mergers and acquisitions, leverage buyouts to kind of pivot towards the market with growth momentum, and to transition towards a new market that they have to. So they have to understand the underlying consumer trends and create innovative products and services and build skills and capabilities. And your tactical view of M&As is, if a goal is to grow that business, it is kind of critical to leverage both the internal capability development as well as the acquisition to kind of provide new products and services to existing customers. You have to improve the quality satisfaction to increase your price, and you have to make that kind of customer stick with you for a long time. So you have to have brand loyalty and acquire new customers for existing products. And from this tactical view, there is kind of this choice of internal development versus acquisition. So you kind of have to see which choice is better for you. Is it better to kind of grow my company organically, or is it in my best interest to kind of form this partnership or acquire a new company? And from a more kind of strategic perspective, a portfolio approach will always consider both. And your capability to transition, as you kind of evaluate these adjacencies to your core business, you have to consider your current capability set as well as kind of new capabilities required to meet the needs of your new consumer set. And you must kind of leverage the best in class capabilities. And this essentially gives you the permission to compete. So this is your competitive edge. And you must develop even more further new capabilities that give you a chance to win and not just compete. So yeah, so we're kind of diving into expectations and realities. So the realities of acquisitions, everyone has this kind of view that acquisitions are these kind of very nice things that will always kind of bring in growth, and they kind of stir up a lot of headlines to begin with. But kind of the reality is, as you can see, these are kind of the reasons of why M&A deals kind of fall through or not transact. So 40% there is that valuation gap. They're just two very different companies with kind of two very different markets and very holds in their respective markets. And 22% unreasonable seller / buyer demand, lack of capital to finance, insufficient cash flow, have economic uncertainty, seller misinterpretations, and there's no market for business. So these are all of kind of the reasons of why M&A deals kind of fail. And yeah, this is kind of a simple graph. So 36% of all M&A deals fall through. And that's just, it does seem like, oh, 64%, that's still kind of a good number, but 34% is quite large considering you have these companies going into these deals very optimistic and very hopeful for their future. So yeah, so how can we not make these deals fall through and have a successful kind of long-term longevity to your acquisition? So kind of the research by the Scale School with David Wessels at the helm has found that kind of successful corporate and financial buyers use 7 key operating principles. And these principles affect almost every stage of the acquisition process, from identification of candidates to kind of post-merger management. And they're kind of, one is insist on innovating operating strategies. So when you kind of initially merge or acquire, you have to kind of consider how are we going to make our operations more efficient and create new ways and not just kind of do what works. 2, don't do the deal if you can't find a leader. So if you're very unclear of who's really running the company and who's just kind of a figurehead, it does raise a lot of red flags. The next 2 kind of tie in together. So offer big incentives to top level executives and link their compensation to changes in cash flow. So that gives them that incentive to kind of work harder and make that turnaround instead of just being comfortable with the newly acquired company. Next is push the pace of change. So you kind of want to rush things a bit at your own manageable pace, but you still want to get things done quickly. You have to foster dynamic relationships among owners, managers, and the board. So you kind of have to have that symbiotic relationship from bottom up and top down. And you got to hire the best acquirers. So you got to have your best team with you. So yeah, with these 7 principles, there's also kind of, this is kind of linked on the, if you want to see the paper for yourself, I can definitely link it in our website, but I kind of created my own 8 ways to handle post mergers and make a growth through acquisition even more successful. And I call it kind of Oscar's 8 priorities. So I guess we'll just get into it. So priority 1, you have to have a market opportunity and validation. So kind of the first question in growth-oriented deals is whether that growth opportunity is real and the combined entities can be realistically capture that growth. So there's kind of some questions you have to ask yourself is how is, as your combined company, positioned in your own existing markets? And how can they be merged / acquired to sustain their differentiated capabilities to sustain your growth? And the next is what opportunities are available to pursue as a result of the deal, and which of them have the highest growth potential. And lastly is how will your target market shift as a result of this merger or acquisition. And so, yeah, essentially kind of market analysis using primary and secondary research can be used to identify opportunities by kind of product, customer segment, market size, or region. And kind of this analysis typically covers the specific solutions and the target offers of how they map into the acquirer's portfolio and the strength of the target's competition. So this kind of disciplined approach to analysis and prioritization kind of forms that foundation for success of other opportunity areas, helping to ensure that all planning efforts are centered on the most highest valued opportunities. Priority 2, so your go-to market strategy. So with your kind of specific market opportunities identified, the next step is kind of determining how these must be attacked. So you have to have a coherent go-to-market strategy, and that's critical to achieving the growth objectives of the deal, maintaining that business continuity and deploying your talent and resources of both companies in the most efficient and effective way. So the questions you have to ask yourself here is, what are the specific market segments for both companies, and what is the combined value proposition for each segment? And how should specific market segments be targeted via direct or indirect sale channels? And does this new entity that you're acquiring or partnering with create channel conflict? And if so, how much? Next is setting revenue targets. What are your revenue? So it's kind of said that you got to have this obsessive focus on the business case when you do M&A, and you're wishing for their success. And one way kind of to actualize this is to focus and establish a specific revenue and margin goals for the deal and assign accountability for the right leaders of your company. So what are your revenue and margin goals for this acquisition? Who will be held accountable for the results? And how can these initiatives be tracked? In the future, if you do become, I know all of our members will become world leaders in the and very top of their field. So I know hopefully maybe you'll look back at Oscar's 8 priorities, and there's some value in it for you guys as well. All right, let's get halfway done. Priority 4, portfolio rationalization. So determination of which products and services of that combined company does take to the market. It's driven, its market opportunity and its validation, because it's conducted by the outset of that deal exploration. And specific consideration should also be given to short versus long-term opportunities, because in the short term, steps can be taken to quickly create new products or bundles or these solutions, but there may be this quick hit of this product improvement courtesy and technologies brought in by your newly acquired business. But sometimes you also need to kind of leverage that value proposition and see if there's any long-term opportunities and fixes. So yes, essentially what you have to ask yourself is that what products and services will be included in your post-deal portfolio? How will they be bundled in the terms of the value proposition and price? And to what extent do you need to rationalize redundant products and services? And how can you confirm portfolio alignment with your business and go-to-market strategies? So you kind of have to just give a fair and rational price to your new bundled services, I guess. Priority 5, sales and channel execution. So yeah, the next kind of stages of your critical execution decisions are kind of based around your sales resources and how they should be deployed and how external channels and partners can be best used to support them. And again, it's important to start with the identified market and your go-to market strategy, as we said before. So one thing that's kind of really important in these M&A deals is that there is that customer segmentation, and that's what kind of ties everything together. Because yet every company kind of slightly differentiates in their own way of segmenting their customers. So when you conduct a merger, it's very essential to understand which target segments are most important across, your newly combined entities, and then decide how to dedicate and redeploy your sales force to match that highest priority clients. They are more likely they're more likely to succeed if they are deployed in the right market segment with the right sales quotas and incentives. So yeah, questions again you have to ask yourself: how should your sales organizations be structured in terms of territories and assigned coverage? What is the new sales incentive or compensation model, and how will it be communicated or administered? What is the right mix of channels to reach customers? And how will your partners be affected by the newly proposed model? I'm just going to take a little quick break to drink some water. If you have any questions, I'll be happy to answer them. This week's has been a bit more qualitative, so yeah, we kind of just want to give you like something interesting and something me and Thomas were both kind of looking into, and something that isn't quite aligned with investment banking, but we still hope you find this interesting. Okay, let's get back to it. So 6, brand strategy refinement. So branding must be considered at every corporate level, and your products level, and your specific product or bundles kind of certain level, and your service level. And branding is everything, I guess. It's one of the first visible indicators of your company's direction and your newly acquired company's direction. And it's like I said, mergers and acquisitions, they make a lot of noise, especially on the news. You see it, newspapers, and it sends a strong signal to both your customers and your employees which direction you're going. So yeah, this you have to ask yourselves, what associations do customers have with both company products and corporate brands, and which will resonate more strongly given the go forward strategy? How can you improve the power and strength of the two portfolios and brands? And what is the plan to transition to the new brand strategy? What specific marketing campaigns are required? Yeah, as I said, branding is most crucial, but despite this, brand decisions are kind of often rushed and made for political or emotional reasons, to get that good headline or to send out a message. But yeah, so it's kind of very crucial for you to kind of make that right strategic decision for the overall health and kind of longevity of this new entity or this acquisition, you know. Seven, almost done, almost done. And yeah, priority 7 is your customer service model. So in the best cases, a merger and acquisition can be this opportunity to improve the customer service of the combined companies, and creating this broad customer service strategy can be vital to retaining customers post-transaction and preventing the deals from affecting services. But as I've been kind of saying repeatedly, these goals can be very difficult because these combined companies may have widely varying services, strategies, or capabilities. And overlapping is one of the main things why some of these deals don't last very long, because you have these redundant contact center footprints, and you're already redundant capabilities or different outsourcing models, you know, may exist. So an effort like a large effort is required to understand the market position of both companies compared with their competitors' servicing capabilities and performance. And the customer service is especially important in some industries and deals, particularly in those that are the consumers that are facing. And in those cases, they should be the focal point of implementation planning. So these questions you have to ask yourself is, how will you maintain and enhance your services levels post-deal close? And how does your service model need to scale up to support your growth? And can we develop a common service model that supports the vision of your combined capability? And lastly, we have priority 8, defining customer experience. So the quality of the customer touches points with the combined companies that can be impacted by even the slightest change of products, sales, or service strategies. You know, I know once I think Hostess kind of fell through with their deal, or either they defaulted or went bankrupt. I never touched a Twinkie again. So understanding these changes and what they mean to customers can make the difference between a strong customer retention and a major uptick. And yeah, what you have to ask yourself is, how does the customer experience of the combined company relate to leading practices or maybe even previous practices? And how does the acquisition present an opportunity to create something better? And what changes, if any, are expected in the customer experience lifecycle based on all areas of your integration plan? Yeah. Sorry, I'm just gonna double check something. Yeah, okay, it's the case study next. I'm probably also gonna run through the case study like with you guys. So, because I didn't get a good look at it. But yeah, so overall, you know, M&A transactions are almost always kind of offer viable opportunities to, you know, achieve core cost synergies and drive efficiency. Uh, yeah, uh, I guess one last point is just it's not unusual for a company to pursue, you know, a merger or acquisition and express high hopes for the deal to be this growth engine. The intention, you know, quite reasonably, is that the resulting combination of your two products, your two entities, your two companies, um, you know, you combine your product, your people, pipeline, and it's going to take your business to new heights, right? But reality kind of sets in, and the combined business has to deal with the presence in multiple markets, this a larger and more diverse customer base, a more complex product and service portfolio, and a high level of people in operational, and you have that increased operational complexity. So some of the early focuses in M&A deals is your cost synergies, your quotas, and it's a tangible that's often quickly, and I guess what I like to say is like it's like a cheap and quick attainable goal, and that kind of takes precedence over the grinding work of formulating, isolating, and tracking revenue metrics and your growth efforts that definitely should not be looked over. And yeah, I mean, cost reduction goals can even conflict with your revenue growth opportunities. And there's little wonder then that a majority of M&A deals intended to specifically enable growth all fail to achieve their express growth objective, while also M&As can be this road to growth, but there must be a lot of work and dedication put into that. So the decision to make that deal is only the first of many decisions that will kind of affect its outcome at the end. And what can acquisition-oriented businesses do, especially to kind of pursue transactions with a strategic growth as a goal to increase, their chances of success? So yeah, so essentially you have to leverage smart planning and to forge solid growth. And as said here, they do offer viable opportunities to achieve your cost synergies and drive your efficiency. But growth-oriented companies shouldn't allow themselves to be trapped by that short-term focus and simply attempt their way to save their way and save some semblance of them, and maybe just comfortness or others to kind of go into this deal, because success in a growth-oriented M&A hinges on taking that disciplined approach based on real understanding of actions and initiatives required to drive short and long-term value. And by addressing Oscar's 8 priorities outlined here, both early in the deal process and throughout that integration, companies emerge as higher performers that capture the expected values of their growth opportunities. I'd just like to say, like, I just isolated like kind of 8 points I was reading, but they didn't list it. So I'm not saying it's my 8 solutions, but it's just something that was in the article that I think should have been pointed out that wasn't. Yeah. You guys also don't have to worry about this for your sector teams, as it's kind of not related. It's just something, this is an off week or a kind of a chill week. So we just wanted to kind of give you something for the future. So yeah, so let me kind of see this case study. I think it's between Blackstone and Hilton. So yeah, so in 2007, Blackstone, this private equity giant that we all know, took Hilton worldwide in all cash LBO worth 26 billion, which 20.5 billion was financed through debt and 5.6 through equity. Oh, so it is an LBO. Okay. In 2018, Blackstone finally sold the rest of the remaining stake in the company, and it realized profits close to 14 billion, almost 3 times the return. So how did Blackstone do it? LBO. So the background. So after a third-party consecutive profitable year for the hospitality industry, Hilton Hotels became an appealing investment prospect for private equity investors, and expanding business transcending borders and rising profit margins called for a strong partnership with established firms in the real estate sector in order to kind of fund Hilton's aggressive growth strategy. Let's see. Employees, do they? Yeah, I guess. I didn't know did he have kids? I didn't know he had kids. Oh, the mechanics. So Blackstone decided to take a large acquisition under the leverage for primarily three reasons. The use of leverage debt enhances expected return on investments in terms of high ROE and IRR. Oh my God, you actually, what's his first name? JC? Yeah, let me continue. John Christoph. Oh my God. Bank debt is a low cost capital when interest rates are low in compensation to equity, and debt financing is liable to tax shield effects. Should really stop laughing because I'm recording this and it's going to be uploaded to YouTube. Oh yeah, that's one other update. So I guess if you I would just recommend going over the slides, but if you ever want future reference and kind of some stuff I didn't talk about in the slides, and especially kind of my explanation of things, I have linked the YouTube videos on the website. It's unlisted, so you can't search for them, but if you directly click on the link that's provided in the website, it'll take you to the video. Blackstone's thesis was to kind of pursue organic growth. So capitalize on market opportunities in Europe and China and launch new brands to capture more customers. And additionally, the firm pursued a high margin franchising strategy. And a quote by them is, "We built an incredible culture, a team aligned around a purpose and a cause to do great things together." And under Blackstone, the number of hotel rooms in the Hilton system almost doubled by 900,000. Wow. So LBO became one of the largest debt finance acquisitions in the world, despite kind of the huge risk associated with debt funding. The deal was well structured and many instruments were employed to hedge risks. And Blackstone's success with Hilton can be attributed to clever financial engineering, to free cash flow and strong execution of Hilton's vast expansion. Someone's paying attention to the 8 priorities. And so this is their private equity dance over the years. So 27 is when the deal happened. Recession hits, that's going to take a turn. Relocates. Blackstone restructures Hilton's debt 3 years later when the recession kind of cooled off. Hilton returns to the public markets with an IPO share of $20. Blackstone reduces. So it's very strategic what Blackstone's doing. So they know at each stage how to kind of employ, Hilton and tell them what to do kind of most strategically. I know a lot of current hedge funds, they have almost kind of a very snake-like tactic with LBOs where they just kind of dump the debt on that company and just kind of make them have to kind of close up and kind of seize all their capital. So that's kind of a sad, but this is very well employed and well thought out. Sells 20% stake of Hilton, and Blackstone's it will sell its remaining 5% stake in Hilton. So to recap, an LBO is one company's acquisition of another company using a significant amount of debt to leverage and to meet that cost of the acquisition. And the purpose of LBOs is to help companies make acquisitions without committing a lot of capital. And PE players use this method to kind of acquire companies, build the companies again, or now kind of most notably to destroy them and to sell them at a profit. I believe there's also a kind of a news article on that where private equity kind of leverage debt to an acquired company, and they have no choice to make that deal, but the main firm is just kind of slowly eating away and just waiting to see their assets. And yeah, so for the sector team meeting, let's see. So yeah, I already planned out all of kind of what you're going to do this week. It's quite exciting. So the directors should send Zoom invites over group chat or email, and you'll kind of work through your plan activities roughly until 1 p.m. And yeah, I'll see you next week. I'll actually be present throughout, so I might hop into some of your sector team meetings. But essentially, what you'll be doing is kind of creating your own portfolio. So we kind of want to see kind of have a small sense of, you employ some of the tactics that we taught you. So we kind of want to, in this case, you have $100,000, and this is without the simulation. So this is just kind of a practice run. So I kind of want you to use this Yahoo Finance equity screener. Your directors have this link, so they'll send it to you. And essentially, you kind of just find companies and kind of build your portfolio and using your $100,000 of equity. And you kind of just list it maybe on a notepad or Google Doc, and you list your reasoning of why you did that. And there's a lot of filters here: small cap, mid cap, large cap, and sectors. Let's see, financial services, and then industry. There's a lot of filters, especially here. These are the big filters, and these might be a bit daunting, but don't worry, because this week I created a glossary of everything you need. So region, keep it as USA, exchange, either NASDAQ. You also have this, you'll be getting this glossary soon. You have cap size, mega cap. So yeah, you can keep this, and I'll be adding to it. And yeah, industry and more specific in each sector. Beta, volatility, we learned this. And then short interest, don't touch this, I'm not messing around. And all your ratios. So I just kind of summed everything up for you. So it's just right at your fingertips, and you can kind of just hit off the blocks with your portfolio of 100,000. But yeah, otherwise, thank you for today. Let me stop the recording.